TGIF, everybody, which my translation is, thank God I found ForexAnalytix. Who's with me on it?
Good early morning, Dale.
Hey, good morning, guys. So I wanted to start with Canada, which I guess you have to call either it's testing the breakout or it's going to be a breakout failure. What do you think?
Just before you do that, Dale, are you seeing any comments in the chat side?
I'm not either. Can somebody write something on the chat?
I just put.
It says chat disabled. You said disabled, so we have the same problem.
They had a problem with doing the flow show. I don't know if it's a Zoom issue, but the chat's disabled for everyone. So people, we encourage people to use the Q&A function and put their.
That's where they are. Okay,
that's where they are.
Them all. Yeah, I see them all coming in
here. We'll keep an eye on that.
Yeah, disabled. It's not working. Oh yeah. Anyway, so we'll communicate via chat, guys. Zoom is went kaboom on that. So let's talk markets now.
If that fails, we use carrier pigeons. Okay.
They've been very reliable over the eons. So except the only pigeons I knew, you would see them on the L tracks in Chicago, and they would leave their white bomb marks everywhere, especially on your car. Anyway.
And they still do. And they still do. Good morning, guys.
Well, that's what they were made to, made for.
hey, just
why did God make pigeons, Blake?
I don't know. Why are you even talking about pigeons? By the way, yeah, Zoom's been a little wonky this week. I noticed that I can't even see who any of you guys as panelists on the right side of Zoom. It seems like it's really wonky, but we'll fight through it. Anyway, I want to let you guys talk about how you feel about the retail sales today, and we have a lot of things actually happening for this Friday, but I'll let you guys go ahead and have some conversation.
Okay, so I know Ryan, you had a nice run of almost 150 pips from the breakout.
Yeah.
So knowing you, I know you at least took partials.
Yeah, I took out up to 132.20s, and I've just been flipped out on my stop at 130.75 on this break back through 80s.
Okay.
So looking a bit false at the moment. I wish they all blew that high on a false break, but
yeah, that was really yeah, they cleaned out the stops and then some. And you were talking about the par level being defended, and even though they pushed it through by 50 pips, it still felt like there were a few attempts to bring it back yesterday. So I mean, it's still closed lower, but EG keeps working. What do you think? I mean, short-term low here?
It's looking that way. I really wanted to buy it this morning. I had a bid in at 05. We got to 07. I'm going to be regretting that all day, I think. But I think there might still be a chance to put this level to the test if we get some really good US data. If we get a dip in euro dollar and we can't break that parity, or we dip under but don't stay there, come back very quickly, I think.
Okay.
So hey, Ryan, since you're talking about if we get some really quote unquote good data, define what you mean is good and what you expect out of the market, because what I'm looking at is if we have some bad data, meaning a miss and it's weak, that is going to be weak for the dollar, strong for the euro, weak, good for stocks. I think stocks are going to actually appreciate some good data. So but at the same time, I can't remember who it was yesterday, and you guys might remember, but I think Waller was the one that mentioned that he thinks that as long as the data is good, what I meant to say is that if the data is good, he'd vote to have a slower pace of hikes. What are your thoughts?
Yeah, didn't he say he didn't endorse the 1%? Wasn't that?
Well,
no, he did not.
what he said was, and this is so to start from the beginning. So good data. If we get a good retail sales and a jump in inflation expectations, we're going to see the usual running from one side of the boat to the other. We had these 100 pip expectations get torpedoed by Waller and Bullard. Waller actually said if the data is very strong, he would lean towards a larger hike than 75 pips, but his base case is 75 pips. Bullard came out and pretty much ruled out 100 pips and said 75 was his case. So these are two really hawkish people. And the market shifted those expectations. They were over 80% yesterday or after the CPI. They dropped down to something like 39% this morning for a 100 pip hike. So that, you know, this is what I mean by the change in the data. But in putting it into trading terms and why I'm watching the euro, I want to see if this parity level holds up again. And if we get good US data and that level gets tested, but it holds, as I say, that's going to be a real good signal for me that we're potentially putting in a strong bottom down there.
Okay. Aussie keeps playing with this wedge line. You have to respect it with the dollar making new highs. I think put in a higher low, but anyway, it's still diverging massively and really is still holding up the best, even with commodities under pressure. So, you know, you still have copper under some pretty good pressure, and we all know what happened to the metals. So,
you know, there was a confluence of fib levels down there at the 67 cent level. We pushed low enough yesterday and pretty much across the board. Here, let me show you guys something really quick.
Go ahead,
by the way, before you do, I think the issue with the chat is that people need to upgrade to the latest version of Zoom. We haven't changed anything on our side, but I think Zoom have. So you need to, next time you log in, before you do that, please upgrade to the next, the recent version of Zoom, and I think it should be fine.
Okay. Thanks, Stelios.
Yeah.
So I want to show you a couple of things with the the euro dollar. We were talking yesterday about the stops being run in at parity, and it hit the 261% extension actually while we were doing the bias chart yesterday. This is for ForexAnalytix subscribers. You know, we go through all of these assets and then more. You know, we identified the 99.60 level as being really key because that was the 261% extension of the last consolidation. Oops, shoot, I didn't mean to do that. There we go. 261% extension of the last consolidation, and that actually that held. And yeah, we probed below just by a few pips. But what I'm going to be looking for today is a move above, you know, this resistance here, this trend line that you see here, and then also this horizontal resistance, which is going to be this other trend line. You get above, you know, 101 and a quarter, then you're probably going to see more of a recovery in the euro. That's a lot of work, and that's a lot asking for the euro. But as I told our traders that are in the ForexAnalytix community, because remember, guys, if you're in the ForexAnalytix community, we have private, you know, just kind of shows for you that are only for our subscribers. Talked about the V bottom reversal yesterday, and I don't see yesterday's move as a capitulation because you know, I explained. Look, you want a good explanation of what capitulation was? Go back into like 2007 when the dollar Canadian was down in the I think it was the low 90 cent level. You'll have a good idea of what happened then. I was trading that day, and this is much different. But that V-shaped recovery, yeah, it gave us you know, enough of a move where I think we can get a recovery back to 103 and a quarter.
Good number.
Yeah, which is it's the big breakdown point. But but there's, you know, we have a lot of work to do. But if you look around, like you were just pointing out, the Aussie did the same thing. We pushed below the lows enough to give us a false breakdown, enough to trip some traders. And then if you didn't see this trend line that comes way back over here in June of 2020 to September, we've had that green line drawn out there for forever. And then on top of it, you know, you got some horizontal support that comes way back over here. So a lot of key levels were tested this week, and if the Aussie gets back above 68.30, it turns very bullish. So, and you're right, Dale, it continues to hold up very well despite the sell-off that we've seen in a lot of these commodities.
Do you know what DSI is in Aussie and Euro?
Yeah, actually, let me see if here's the ForexAnalytix chat room. By the way, if you guys want to see, this is what the ForexAnalytix chat room looks like. We have obviously our general chat room. We have our trades room where we're putting in what trades we're doing. The Flowonomics is the macro chat room. We have news and research, which I try to post the DSI, and here's the DSI from yesterday. So we have the Aussie DSI is at 10, so very extended.
Euro at 8.
Yeah, Euro at 8. And by the way, inside of our chat room, you also have threads, not discussions. Well, you have discussions too, but these are threads of us talking. So if you go into the general chat room and you see, whoops, not that. Here's the threads. You can see everybody, conversations that we're having on the side. So this is one of the most active and interactive chat rooms that you're going to find for traders. We don't talk
like the
politics.
talent in there.
Yeah, we have a lot of good traders, and I'm not talking about just the ForexAnalytix team. We have a lot of good, solid traders that are very experienced. We have a lot of people that work at banks that are inside of our chat room. So, and remember, if you go into the trader funding program, you actually have that available to you for a certain period of time, because we want you to have ideas when you're in the trader funding program. So make sure if you're in that program, make sure you check that out. But I want to ask, first of all, let's start with Kman. I haven't heard much from you. What's the most important data for you today, would you say?
And good morning, Dale.
Good morning.
Good morning, America. Good afternoon, Europe. It's twofold, right? Because we have Waller, who told us specifically that he was watching the retail sales and the housing markets to form his opinion on whether it's 75 during the next meeting or if it warrants higher increases. And then we have Powell last time talking about the Michigan. So both data, in my opinion, have the power to make things move this afternoon. And actually, I pretty much agree. And recall, Blake, we spoke yesterday about when I said this may be kind of the at least for now, a final dump of assets and currencies, and we could stabilize from where we were. And we were talking exactly about that 66.80 in the Aussie, 99, mid 99s on the euro, and as a matter of fact, everything stopped and started to reverse. I've also played that dollar CAD outbreak, but I took my profits actually pretty nicely in those 132s.
You did scalp it pretty good out there, because I shorted it yesterday and I made some money on the downside, but you really played it to the long side, you and Ryan. So well done.
And then this morning last night and this morning tried it again, did a bit of ping pong between a few levels, and went out before it broke back down, to be honest. No, so I think both data points will have the possibility of moving things around a little bit. And as people rightly say here, it looks like we may be at least building a pause in the heavy dollar buying. We're back on the break level in the Aussie, 67.60. We're back below the dollar CAD, 130.85. The parity in the euro. And I must add, there's a lot of options interest in this 99-101 zone on the euro dollar, and parity. We saw peak demand around parity for a couple of sessions, and apparently that has to do with hedging of large options as well. So. Below parity, we may see a bit more of that going on, because those people seem to have taken very large positions when the European gas situation started to sour. So we have to really pay very attention in the upcoming sessions of how it's going to go Nord Stream and things like that for the euro.
Yeah. What do you guys have any opinions on Nord Stream and that because the date is
July 21st.
21st.
Yeah, I was going to
Same
say it's
day.
the end of next week, right?
Same day as the ECB.
Fantastic. That could be a wonderful day for the euro. It could be a really bad day for the
On
euro.
the 21st
I don't
of,
think they're going to. I don't think he's going to cut him off. Then he's used all his leverage on Europe, and I don't think he wants to really alienate all of Europe. So
if
that's
that
my
were to be
call.
the case, if that were to be the case, Dale, and if, as Olli Rehn said this morning, ECB would only do 25 BPs, I think then I reckon we don't stop at 99 in the euro if Russia cuts European gas off. And ECB does only 25.
Right. Well, how about this? If the ECB only does 25, because they're probably going to make their announcement. The ECB is probably going to happen before you get the news on the on Nord Stream. So if they only raise rates by 25 basis points, 0.25%, and then Russia turns it back on and everything is copacetic, you got to buy the crap out of the euro, don't you?
Well, I mean, that's the thing. You will have two binary events in one day. So do you buy euros because Russia turns on gas again, or which I think is probably going to be the most important one, or do you sell euros because ECB does only 25? But I mean, imagine ECB does 50 after all, which I think is a real possibility. And Russia turns on gas, then euro is back at 105, 106 in my opinion.
Guys, the bottom line is that unfortunately Putin is controlling energy at the moment. I mean, you're seeing the U.S. strategic petroleum reserves being at the lowest they've been in years. I think it's less than a month's worth now that they have.
And speaking of which, Stel, I just need to point out that we had a false breakdown in crude yesterday too.
Yeah.
So continue on. So I'll pull it up.
The market's still tight, and we had the down move. One of the main reasons for that was the release of the reserves, and you're seeing now today we're talking about gas. Germany are tapping into their reserves, so this is not, cannot be bearish for energy prices because you're depleting your reserves, which is crazy. So Putin, I mean, they have to do that. So Putin still has huge control over energy prices. So he still has huge leverage. I think he can do whatever he wants, unfortunately. So he will want something in return in order to turn the valves on and, let the supply go. So,
what's he gonna want?
Ukraine? I don't know.
I
really don't know.
Yeah. So interesting. Well, Stelios, thank you for that. How do you feel about today's data? What do you think is most important today?
I think retail sales is the most important. They told us, what was his name? I keep forgetting his name.
Waller.
Not Waller, the other guy. Waller, yeah. New York Empire State, also very important number. It tends to get overlooked, but retail sales for me, yeah.
Actually, one of the Goldman analysts thinks that we're in a range between 3,700 and 3,900 in the S&P.
Wow, what a great call!
I know, thanks, dude.
That's what he gets paid $500,000 a year to do?
Yeah, probably. At that. Yeah, it's definitely more than that. Anyway. Yeah.
Did you have that saying on your floor days, Dale? A quote wide enough to drive a bus through?
Yes, buddy. So Anyway, it's aggravating. All right.
It is,
and very actionable. What a great actionable idea.
Yes. Well, the other thing to think about that is just the S&P. I was looking to actually get long some risks via the S&P down here. I was actually hoping for a move down here yesterday. I think I was looking for 36.90. No, I never got there, unfortunately, because I was going to play that card.
Still get there.
We could, today. I don't know if I'd want to play it today on a Friday though. That's the flip side, right? If we see that level
next week, maybe.
Because data is like let's say data is super hot, strong retail sales numbers, then inflation expectations, consumer sentiment's really strong. Let's say we get those types of back-to-back pieces of data, stocks are going to come off. They're going to sell off.
Yeah.
We should trade below 3,700. So
you have a view on notes or bonds here, Blake? I'd love to see your note chart.
I don't. Here's the tent. And by the way, if you want to know like my technical view, well, first of all, I think this might be an inverted head and shoulder pattern, but you can see right now it's just more of a triangle consolidation. So I think it looks something like that. I'm venturing to guess, but this is something that is covered on your ForexAnalytix platform, Dale. So whenever you want analysis, you can just go here. I'm joking, but you can.
I've tried it.
But you can.
I
So
go there like occasionally.
Yeah, we have our harmonics updates and everything else right here at ForexAnalytix. Right. But yeah, I think that I think rates are going to continue lower, and you're going to see a bond rally near term. But that's my view. Ryan, Stelios, do you have any views there as far as
depends on what you call short term. I think we're going to have one more push higher, new highs in yields, and then that's terminal.
So a 30-year like this.
Yeah, and then that's terminal.
For a 3.
That's what I think.
You guys can just suck it.
We can suck it.
Yeah, you just suck it. All right, whatever. By the way, somebody got in the chat box. Yeah, that's Jane. She says it's OPEX day today for what it's worth. Thank you, Jane. Just so you guys know, Zoom has been a little wonky, and if you're coming in a little bit late, just use the Q&A panel today. Hey, Ryan, Mike asked you a question about the euro. It says, hey, or this is for Ryan and Kman. Will you be shorting euro dollar above 101 and close before next week's ECB meeting?
Right now, no. I've already explained. I'm more bullish than I am bearish in this short-term period above. While we're close to parity, I'm bullish. I won't be shorting it right now.
Very good, Kman. What do you think?
No, I'm going absolutely neutral right now. I might be trading ranges, but I still keep my euro mix short, but that's a more of a longer term position, and I may manage that next week as well. But for the time being, I'm quite neutral. There's just one more thing that we should talk about, and that's on the yen side. If you could put up it doesn't reflect in the price action, but well, first of all, there is a bit of price action indeed, because we had that 139.42 level, which we highlighted as well, and where it stopped right there. But then we had some interesting comments out earlier today, where Finmin Suzuki stepped up the rhetoric a little bit, saying that they are seeing speculative moves, and out of experience, that is very close. That is a very close level, and that's raised the alert here to say that they might be getting very close to interventions. That's really the last or one before last step. Will
the U.S. coordinate with them, or will it just be BOJ?
Well, I mean, that's an open question, Dale, and therefore I also said in the chat room that we have to be careful. If they don't intervene during Asian time, we have to be careful at least when the US walks in, because if they need the Fed's help, they will wait for the Fed to be operational, right?
Great point. I think because the Fed has the howitzers.
Come again?
Because the Fed has the howitzers, the heavy artillery.
Yeah, but
they've got enough.
And also, if they will, as they have been saying already many times, they will communicate with other central banks. And since the big problem seems to be dollar yen, they will communicate with the Fed, especially since also we had Yellen's visit to Japan earlier this week. They will communicate strictly with the Fed and likely also the ECB. But I think the Fed is the more important in this one if they decide to call in the help of other central banks.
Nice. All right. Well, one of the things I remember about the dollar, excuse me, I'm sorry, I've been a little under the weather the last couple of days. One of the things about the dollar yen is we technically, it's hard to be bearish. It's hard to be super bullish yen, but it is up at the top of a channel. So, technically I would think it rolls over somewhere around here, but I've been on the wrong side of this one a couple of times over the last.
That's why it's so hard to
months.
do, but
it
sure is
really
tempting.
I think a lot of people were saying it was technically high enough at 115, and then 24 big figures later, we're still technically high enough,
Yeah. Hey, silver, Stelius. I know. Did you see what I identified yesterday?
No, I missed that. If it's bearish, I don't want to know it.
Okay, it is so bearish. You're not even gonna want it. Your head's gonna spin. No, actually,
okay,
silver. This is a 3-month chart. I should just go through a monthly chart. Monthly chart will be sufficient. If you take the post-COVID lows, so the spike, the lockdown lows, to the highs post-COVID, we're at the 618 retracement. So that comes in right now at 1835. And if you look at this previous spike high, it connects right just below where we're currently at, and I believe there's going to be a lot of support around here in silver. So just FYI, man, this might be the time you load up.
I've done it already.
I'm
full size.
Did you already blow your wad that early? Jeez.
I told you 1880. Oh, you weren't there. You were away.
I might have been away. Yeah. All right. Yeah, so if any of you guys are also wondering about gold's at the 127% extension of this last major leg higher. We happen to be at that 127% extension. RSI has been divergent. That doesn't mean that it's bottomed, but it is at least finding some support. Doesn't mean it's going to reverse either. All right, so we got about 3 minutes before data comes out, and I'm assuming Peter Goodburn is here today, right?
Yes,
Dale. Okay, so I'm going to
not here yet. So
okay. I'm going to pull up the data flash now. For those of you that are ForexAnalytix subscribers, this is like really good little piece of information here. It is. It's inside of the ForexAnalytix program. Sorry, I'm going to pull up the dollar yen. Actually, you know what? I'm going to pull up the euro today because I think the euro is going to be more of a mover than the yen. Just my 2 cents. So I'm going to pull up the euro. I'm actually going to. Oops, I did not mean to do that. I'm going to pull up also the S&P. So the S&P is over here to the right, and then you can see this is the euro right here to the left. And I've got on 15-minute charts on each. Okay, so we're going to have retail sales. So let's see how those retail sales numbers come in. By the way,
I
Aussie's
bought some
trading
underwear last week.
You did? Way to go!
Maybe huh?
Yeah, I mean, did you have some like racetracks on them? I mean,
I
is
knew
that
you're going to go to skates? All right,
come on,
sorry,
we have to.
sorry,
What is this?
sorry everyone.
I just bought a few dollars on that info there.
Yeah. Anyway, we'll see.
All right. Any last minute thoughts? Stelios wants to buy silver. Ryan's gonna continue to be long the euro. Kman, you're don't know what to do with the yen.
He's
but
strongly neutral.
Joking aside. Dale, what are your thoughts here ahead of the retail sales? Anything?
I'd like to see that this is going to be the turn in the dollar. I know it's early, but we don't have a reversal signature yet, but it feels like that may have been it. So,
all right,
I'm with Ryan.
You're neutral.
Yeah.
Okay. Any last minute thoughts? You guys have approximately 45 seconds. Last minute thoughts or ideas? Anything we should be looking at? I mean, this is what I'm looking at right now. I'm looking, for the commodity currencies. I'm also watching copper too. See if copper catches a bid here. That's gonna, I think, help the Aussie and the Kiwi along. That's kind of some things that
that's driven. Copper's been driven by China, right? And GDP print was pretty bad today.
It was, but the PMI data didn't look so hot, or it looked so bad. So they think that was like kind of things have already turned higher for China. So that's something to think about. They're relaxing their COVID policies too, which, by the way, COVID's going around like wildfire all over the place too.
Is that what you have? My sister has.
Empire State's very strong.
Yeah.
Retail sales I don't see yet. Drum roll.
No, look at the S&P just kind of reversed here. Do you guys see anything yet?
Means higher rates.
No. Empire looking pretty strong. That's a decent bounce there.
Yeah, it is, and that was the initial knee-jerk reaction lower in stocks, and
I don't see it. Where is it?
I don't see it either.
It's because they don't get it in advance these days. This data, all the wires have to go to the BLS. There we go. 1% beating 0.8. Core sales 0.8 versus 0.3 expected. Looking good.
So pretty strong data there.
The revision slightly lower though, but still, I think it's better than expected.
Yeah.
And Canada well below the breakout now, right?
And
Under
yeah,
31.
well, it is, but also, you have to be careful here, right? It's the dollar CAD. Let's pull it up really quick. It is below the breakout point, but look at the dollar, how it's firming across the board. I mean, you got the Aussie coming down.
Yeah.
You got the Kiwi coming down. You got the euro coming off from that trend line reversal.
In the euro.
Yeah, I mean, look at this. Swissy bounced off of support. So look, if you're trying to play the dollar on the short side and you're shorting the dollar CAD, you got to be careful with that because you got everything else that's kind of firming up. So, but remember today, that's not it. As far as data goes, the University of Michigan data, that's the data that really influenced the Fed to go from, people believe that it influenced the Fed to go from a half a percent to 0.75% hikes. So that's the number that, is going to come out in a couple hours. It's something that you should be paying attention to. All right, guys, I want to say thanks everybody for your support. As always, make sure you try out ForexAnalytix. It's only $1 for 10 days to jump in our community. Check it out. Our community is pretty solid because we don't talk politics. We don't talk, religion. We just, we talk trades and markets. So, by the way, here comes the dollar. The dollar is coming roaring back. And then also check out the trader funding program if you get a chance. If you want to learn how to get ForexAnalytix included, come check out the trader funding program. Just watch the video at the very bottom if you want to trade our money and not your own money and access larger accounts and keep 75% of the profits and have no risk, meaning you're not risking any of your money. Check it out. All right, Dale, is Peter here?
Yes, he is.
Okay, great. I'm going to pass it over to you. Hey, team, thank you so much. Peter, thanks for joining us today. Happy Friday, team, and I'll see the rest of you all. I'll see the rest of you all on the Morning Edge.
Yes,
thanks, everybody.
And thank you, team, for providing elite content all week long in F.A.C.E.
And you yourself, Dale, for leading the pack, being the shepherd to us sheep.
Thank you. Be careful. I'll hit you with my cane. All right. Anyway, thank you, guys. And Peter, welcome back. Welcome back.
Great, Dale. Thanks very much. Yeah, can you hear me okay?
Yeah, could hear you clearly. And if you want to share the screen, we just had some data, and I'm interested in what your views are and have some questions for you.
Okay.
So, okay.
Sure.
Would you mind if we started with the dollar?
Oh, sure, we can. Yeah, let's have a look.
Because, Peter, what I've noticed is the dollar's running the show. And it seems like it's all one market. When the dollar's strong, everything is under pressure.
Yeah.
We'll see. We haven't had the chance to really see, dollar weakness lifting anything. But it seems like the whole market is financialized. And even wheat and beans that have nothing to do with, Fed tightening, all have the same chart patterns. have you ever noticed the market being this synchronized before, where there's
Well,
no
I mean,
differentiation between the asset classes or just magnitude?
I think this is a function of the inflation, really, because I mean we've always used Elliott wave as a tool to cross-reference the different asset classes in order to gauge exactly whether a count is correct or not. This has been really useful. Occasionally, those correlations break down. I mean, a good example was really gold accelerating higher last year when the dollar was going up. You know, because that was all about people getting excited about inflation, thinking back to the 70s and thinking that gold would be a good medium for hedging that. And then later we got to March, we attempted the August 20 lows, gold started to drop, the dollar kept going up. And from then on, the correlation switched, you know, back to its inverse correlation with gold versus the dollar. And I must say, actually, when it comes to currencies and the dollar index as a gauge, there's a couple of observations which and I'm sure everybody's picked up on, but I'll repeat them. And that is, first of all, that the dollar's really this strong on the basis of really two other real currencies which are weaker, and that's the euro and the yen. If you'd stripped out the weightings of the dollar index and the yen out of the dollar index, we wouldn't even be breaking the pandemic highs here. We wouldn't be trading above that. We would be basically starting a new downtrend from that pandemic high, much the same as many of the other G10 currencies have done. We'll take a look at some others in a moment, if you like, just to make a comparison look. The other observation is that in order to time the exact high or get the price right in terms of where a peak of the dollar is coming, I think it's quite helpful to look at gold, because since March, that inverse correlation has gone back in sync again. You know, we're not seeing the gold as an inflation hedge at all. I mean, look at poor old gold. It's dropped enormously this year. We're down 20% or whatever. So, you know, you're not going to. So what I think is that the correlation is the negative correlation has dropped back. And if we can be confident about a wave pattern for gold, which I think we can be, we'll come to that in a little while, then we can probably time the dollar.
Okay, so more confidence in the gold count than the dollar count. And there's, there are times where I do have conviction about maybe a target or a level or something like that. And I wait for that level in that instrument and then extrapolate it to the other instruments that are related to it. So it really only takes one good count to give you an idea of where everything else would go.
Well, exactly. I mean, that's exactly right. I mean, we do this every day when we if we want to look at the S&P, for example, and some of the data in the short term might be a bit messy. Then take a look at the Dow and maybe compare it to the NASDAQ. If that doesn't help, see if there's a really clearly defined pattern in maybe something that's somewhat correlated, but not necessarily directly correlated. You might want to look at one of the European indices, for example, which we've been doing recently. In fact, it was only this week that we did make that comparison earlier this week and said, hey, look, the Euro Stoxx 50 has had 5 waves up from the previous week's lows.
Yes.
And it's in a correction. It's going to dig deeper this week, but which puts a rather finite correction limit downwards for the S&P. So you can always do that, and it's really useful. The more apt you are at practicing this, the better trader you will become. So anybody out there listening today, really honestly, I can't overemphasize the fact that you should really be looking at markets, no matter whether you're trading just 1 or 2 contracts, even if you're a specialist short-term stock picker or you're trading some of the indices, that you should really widen your horizon a little bit and make these comparison studies. They're going to really help you a lot.
Okay, so confidence in this count, a few different levels in the gold here. Time wise, is this going to stretch out to the fall, like the S&Ps may stretch out their correction to the fall or the end of the year?
Well, I think this is going to be completely different sort of correlation to what the S&P is going to do. I think this
to
is
the
more in
dollar.
tune with the dollar. I think this
Okay.
is telling us when the dollar's going to peak. Now there's a necessity of 5 waves down from the March high. So I'm going to do a couple of ratios for everybody to have a look at. First of all, I'm going to extend 1 to 3. This is like 1, 2, 3 down here to 1789. I'm going to extend that by 61.8, which is the golden ratio. So that gets about 34.85.
Okay.
And then I'm going to use the inversion of 61.8. So that's 1618, just the inversion of that. And I'm going to extend the first wave right here by 1618. If I double click, it's going to project that for me. And you can see that they're coming in within a few dollars of each other.
Confluence, yeah.
So when we do see something like that, there's a very strong sort of pull towards those numbers.
It's a magnet.
Yeah. We've got some deeper levels. I mean, for example, I noticed that we saw some quite overshooting in some commodities just this week to the downside. You get sometimes, not very often, but sometimes you might get this number being overreached slightly in a one-day splurge of exhaustion. It might come down to this 1595 area, and then suddenly the next day you wake up and it's back above it. It's almost as if saying, hey, guys, I recognize this level as being really important. I've gone slightly below it. It was out of my remit, so I'm back above it again the next day. And that's when you get a classic reversal signature, and then you can start moving in. But I don't think this is going to take too long.
Excuse me, I'm sorry, Peter. All of this work is a 4, which implies after this bottom we should get a hellacious rally, right?
Yeah, I mean, I think that once we've got down somewhere down here to the 1684 number, 1684 number minimum, 16. What did I say? 16. Yeah, 1634 number. Sorry. Once we've seen that, we're getting a really nice flat pattern here, finishing for primary A4. And then we're off to the races. Then we can really start moving up, and all the bulls can go back in. And they'll have their day. At the moment, they're suffering, but they'll have their day. What I've done is actually, it's a bit of a plug, but actually it's relevant to the conversation, is that I know if people listening in, they like the sound of buying gold, you buy physical gold, that's always worthwhile. But I'm a great advocate for buying silver over gold, because I think the gold-silver ratio is going to narrow quite significantly.
Okay, we're almost at 93, 95 during this process, during this final stage of decline in both gold and silver. Where are we going to 100?
No, I don't think it's going to go that wide. You can see
well, we've already been there, right? 92.40.
Well, that was my target a
Okay.
little while ago when it was down here at 84. And so you can see we're just coming into it now. Here's the real-time data.
We're almost there.
We're almost there. That's quite a big retracement of the preceding decline. But you see,
Halfway.
once that's going to top out wherever silver bottoms, basically. I mean,
right.
this is all directional movement. I mean, for example, when the ratio is narrowing like this, silver's going up.
Yeah.
Okay, so this is the pandemic rise when silver was $11
right.
something, going up to sort of $20.
Right.
And then this correction up is the correction down in silver since August 20. And the same for gold, since gold's been doing this flat pattern since August 20 as well. So once this tops out, and it's getting pretty close, it's going to start turning down, and then silver's going to be a big outperformer in the next 2 to 3 years. We're going to go from, it's going to basically be outperforming gold significantly. But the interesting thing about this is that I think that platinum will outperform silver, and palladium will outperform platinum.
And they're much weaker. They haven't turned yet.
Yeah, palladium just started to squeeze up a bit. I just published our mid-year commodities video. I can give people details how to subscribe for that one at the end. But in there, I'm showing how the relationships are between gold and silver as this ratio you're seeing now, but also how silver and platinum looks. Platinum therefore would outperform. And then we can work out, basis the ratios that we're applying on that, exactly how far the underlying bullion commodity will travel. And that confers in with the actual targets that we have as well. So we're getting some pretty solid research done, which tells everybody that, hey, look, if you want to be a gold bug, why not be a silver bug as well? And if you want to be a silver bug, be a platinum bug. And if you're not used to trading palladium, then you might want to sort of have a look at a palladium ETF or something, because that should really be the big star performer.
Interesting. You know, Peter, I've noticed, you know, I'm long and wrong some miners, both gold and silver. And my silver shares that I'm in are holding up much better than the gold shares. I mean, they're barely making new lows with the recent huge sell-off in silver. I don't know if you looked at them, but I know you look.
The one I'm most familiar with is Fresnillo. You know, don't know whether you know that one.
I'm like in Endeavor, and I forgot the other one that I'm in. But
Fresnillo, I could have a quick look at that.
Fortuna.
Fortuna. Oh, I have got something like that.
But they have been acting a little bit better, and
yeah, I mean, this is Fresnillo on a weekly chart. It looks okay. It looks as if it's already finished its correction down here.
Yeah,
having a pullback now, but I mean, if this level holds, it looks good. You might, if you haven't already gone long of something like this, you might want to wait for a little bit of an uptick from a level above 610.80. That would give you a more affirmative confirmation that we're ready to start the next trend. But over the next years, you know, this can do a lot. I mean, yeah, you can see where we are. The price level today at 653, and we're talking about 3,500.
5 bagger. Yeah.
Yeah, I mean that, and that you know, on an unleveraged basis. I mean, the stock market's not going to give you that in the last phase of the stock, you know, of the bull market. I mean,
right.
Once we get across this year, next year we start turning bullish again on the stock market. But it's not because of the depth of this year's corrections coming through. You're not going to get, you know, 5 multiples to the upside in the S&P or anything like that.
What do you think it'll be led by? Commodity stocks? You know, what's going to rally the market next year? I mean, the leadership for eons has been mega cap tech. Do you think that it's going to be things like Freeport McMoran and metals and, you know, industrials?
Well, you'd like to think so, but to be honest, they're so highly correlated that this year, if we do get down to these numbers, this is my daily. Well, for those of you tuned into some of my work already, you might have remembered that we've been talking about this big swing down this year to something like a very deep correction. And we've been tweaking it here and there, depending on what's going on so far from the top. But otherwise, the targets are much the same. They're not that different. But I don't know whether there will be a leader or a lagger here, because they are pretty much correlated. I mean, normally you get correlations. If they are fairly tight but diverging slightly, they might diverge for a month, maybe 2. And it's always worth checking to see where the position is. I mean, obviously we use Elliott Wave to do that, which is very instructive, because I don't know of another technique that you might use to find out whether or not something's leading or lagging. I mean, how do you know when one is turning and the other is not, unless you're using something like Elliott Wave? Even an oversold condition on an RSI or something doesn't necessarily give you the exact numeric sequence of turning. So and certainly the fundamentals won't. So I
know, Peter, that you were also negative copper, and you're looking for about 30% decline, and it was more. It exceeded your expectations, actually, didn't it?
Well, there was we had a couple of counts in there, and one was well, I didn't want to frighten anybody. I usually work with the minimum expectations because we have quite a few clients in the copper industry. And
back to 50 cents when I was a young buck broker, under a buck.
God, yeah, well, it was in those days. Yeah, I remember those days pretty well. Let's see if I've got this. Well, I mean, this copper market. One of the things which is very important that's happened this month is that copper's actually broken below the 73.12 level.
Yeah.
And of course, that means you've got overlap in these price swings. So I think what's happening is that we're in a diagonal for primary wave C. This zigzag upswing from the financial crisis lows, we've had this pattern really since, well, for the last 11 years, it hasn't changed. But of course, you've got an expanding impulse pattern here in wave A. But in wave C, you got this, what's now becoming obvious, is an overlapping diagonal impulse. And that's where you're allowed to see wave 4 overlap price levels of wave 1. Now, I think we're very
perhaps copper runs more with the S&P. We get this
Yeah.
X wave and a pop here, and then when the S&Ps roll over again, takes copper down again.
That's right. Yeah, we might even dig back. I put in 61.8%, but actually, fourth waves can invariably be 76.4 retracements. So when we measure like this is the 61.8 area. We might even later be digging that deep and opening up the boundary line here a little bit. That won't matter. In fact, it probably might even look better. I think we're due for a low around December time. This is often when copper actually stages reversals. Had quite a few in the December sort of January time period before. So something like that could bring us down to these levels later this year, and then I think we'll get our fifth wave. But if we do that, it's an amazing upswing. If you go from 5.5 to maybe 13.5 or 3/4.
Yeah.
But
Huge.
at the same time, you're not going exponential anymore. This diagonal will tell us that there's a finite limit, and also it's very instructive because the fifth wave within a diagonal has certain limits. So it eliminates anything going up to exponentially,
like
17
silver
20,000
and
or
what palladium and platinum will do.
exactly.
So,
yeah.
Yes. So it's in the precious, not industrial.
Yeah, it's not in the industrial metals really. I think they've had their, they're going to do well, but they're not going to do as well as the gold miners or some of the other precious metal miners. Or if you can be smart and get long of a palladium stock, that might be good as well. Things like that.
Uranium, Peter?
Yeah.
I think I asked you once. There are a lot of uranium players out there, really being brought to light because of the energy crisis and a lot of countries deciding that they may have to go back to nuclear. And, there's been more and more participation in this uranium space. I see it a lot on Twitter, a lot of interest in it. So,
well, that's good because, we have updated uranium in our, I'm showing you sort of
in
stuff
your mid-year?
In our mid-year report. Okay. But okay. Well, let's have a look. I'll show you a glimpse of what uranium's done. This is going back to the all-time high here. But this is spot uranium prices. We think there's going to be another fallout here, drop this year.
Okay.
But that's purely because of an expanding flat pattern from 58.
Nothing phenomenal there.
Nothing phenomenal there. I'm a bit cautious with this final target. It could be higher, but I don't think it's got enough oomph to break into new record highs or anything. So that one, is
an industrial metal in a way, isn't it? Right.
Well, it very much is. Yeah, it comes within that remit of industrialization and that sort of. So I think that it's not going to be quite as outperforming like the base metals. I mean, they're going to be good gains, but could you be looking at, if you want to leverage, could you be looking at something else? Now, some people are very familiar with maybe trading uranium on a spot basis or an ETF, and we've got a few in our report we've got a couple of ETFs on uranium. I won't show you those now because I want people to pay for the report, but to be honest,
I'm not crazy about radiation, buddy. I had enough of it. But anyway, I wanted to also bring in that a lot of people are looking at what's happening in yields, and I think that you've had a little bit of a change of messaging on there, where we thought that we were going to top, and then you saw this recent decline that's gotten you really constructive for higher yields.
Yeah, that's right. I mean, at the beginning of this year, when we looked at the correlations again, we said, right, well, okay, if we're expecting the stock market to be a down year this year, and quite a big one, then we'll probably end up in a sort of a safe haven environment and yields pulling down at some point. So when we started looking at the overlapping sequence on a log scale chart with 10-year treasury yields from the pandemic low here at 37, pointing to it now on the bottom left, it looked very overlapping. We thought, right, well, this looks like a diagonal. in a log scale chart. And if we're going to start talking about a big stock market decline this year, yeah, and the bond markets attract safe haven buying, it's going to pull yields down to maybe 1.5%, 1.75%. But when we started making comparisons recently, especially since the top in June, and looked at the way that the declines were unfolding, they were all basically corrective, and they weren't big enough corrections to substantiate those targets down to 1.75 really. They just weren't big enough. They were too small. Then we transferred our analysis to a log, from a log to a linear scale chart, which was similar to what we're doing already on a linear scale chart for the German Bunds and the yields there. And we realized that they were very similar in sync. So that adjustment had to be made. And that meant that really this downswing was just a minor correction within 2 successive upswings, which we'll have to develop probably into next year. This is a daily chart. I couldn't fit it all on one screen, but you could actually push out these parameters, into the middle of next year easily. I think at the moment, what I'm expecting is a bit of a range trading session for the next few months until the end of September, until the end of the Northern Hemisphere holiday season. So I think we're going to do something like this as a triangle before we go up sort of like year end and then pull back and then continue into the first half of next year. But it looks as if, that's going to continue up. And I'm wondering now whether we're going to be in a range trading session in the 10-year treasuries for, say, until September, the end of September. And that's going to keep the stock market running a bit higher, and then eventually we're going to get this next swing up, which is going to knock the stock market down again. I don't know for sure, because these correlations are a little bit unreliable.
Wonky.
Yeah,
that's the word Blake uses, wonky a lot.
Yeah.
Anyway, what I respect is that I've seen you change your targets and counts. I've rarely seen you change your mind about what your narrative and bias was, and that's what I thought it was important. And really, I'm a big believer in, if you don't learn how to change your mind, you won't have any change left. And that's a big change for you. I wanted our viewers to be aware of it.
Well, thanks. Yeah, I mean, obviously, we can't just dig our head in the sand. If the evidence is coming up and saying you got to change, you got to change. I'm afraid that's it. I mean, you're right. We don't have to make those changes so much, hopefully. But a lot of our clients, they're major hedge funds and institutional pension funds, and of course we've had a lot of dialogue with them since changing this at the beginning of the month in the last 2 weeks. So it's been quite an ordeal, but. The good thing is, I have to say that we've had some great feedback from clients, from some of the bond traders, and I think we've settled on the notion that looking at the evidence as it is, that we have to make those changes, and that it's unrealistic to hold on. The funny thing is, and I have to say this, and maybe anybody listening in might have caught up on this as well, is that here in Europe, all the bond market traders are so bearish. All they talk about is really recession in Europe because of high gas prices and everything. And you probably saw that the ECB had revised their economic forecast in the last 24 hours downwards. And everybody's so bearish. And yet these are the same bond traders who are not buying the bonds. Because if you put the stock market like for like against the bond markets, yields should be retrospectively a lot lower if you believed in recession. I mean, if you really believed in recession like the stock market traders are believing, the yields should be a lot lower, and they're not. And that's the stark realization that I came to. I thought this decline from June, it's just not unfolding in the magnitude or into a 5-way pattern enough for us to maintain much lower yields, much as we would have liked to, relative to the normal correlation with stock markets, but it just doesn't add up. So when I talk about the bond fund brief guys here in Europe, I'm saying to them, Well, okay, you're talking the talk, but you're not walking the walk here, boy, because basically, you're not buying the bonds. The yields are too high. You know, if you were thinking of recession.
All right, so just gut feeling, we've had a little pop here in euro, but you think this could be another failing rally, and Dixie could maybe trade 111. Is that correct?
Yes,
and euro could trade what? All the parity people are going to celebrate. Where are we going to? 98?
Well, I think it's I've had these sort of targets shuffled around a little bit, and but I must
could
admit,
that have been it yesterday, Peter?
Pardon?
Could that have been the low yesterday?
Well, it could have been, yeah, 99.52. It could have been the low. The only reason I hesitate is because of gold, because I'm pretty convinced that we're going to have a look at that 1634 number.
Okay.
And in which case, then I think the euro might just be in a sort of a fourth wave here.
Yeah, 103.20 is important. That was the historical breakdown, 103.50. So we don't get there, and we have one more wash out to 96. Okay.
Yeah, it could easily do that. And then the thing is that I think if you want to buy the euro or buy gold, you know, just keep a lookout for these two relationships. You know, they're positively correlated.
Thank you for thank you for edifying the community once again, Peter.
Yeah, it's a pleasure.
You want to show your website where people can get a hold of you and maybe check out your video on your update of commodity markets. You're talking palladium.
Oh, that'd be great. Let me just get let's have a look here. So here's wavetrack.com, and yeah, I mean, if you'd like to subscribe to the video series, actually at the top right hand corner here under news alerts, we've put in the mid-year commodities video update. Now this is part 2 of our series because we're doing a trilogy series. Part 1 is stock indices and a lot of different types of ETFs and equities in there. Part 2 is commodities. We just released that, so that's what we've touched upon today with things like uranium. There's a couple of ETFs in there, URNM, URA.
Yes.
We've also got some rare earth ETFs in there, which are really worth having a look at. But we've got the basics. And if you want to check and see what's in there, just scroll down to the bottom. You can see all of these contracts are in here. It's quite a big list and quite a few different equities.
You're covering kryptonite?
Kryptonite. Superman's kryptonite. It's
the only mineral you're not covering. So
yeah, we got the Wizard of Oz limited copper. You know, that's about as close as magic as we could get to, I think.
Yeah.
But if you want to, so the details there to subscribe to that or the stock indices stuff. And the part 3 will come out later this month for currencies and fixed income. And in the meantime, if you want to keep more up to date with the short-term sequences, then you can go into subscription and go subscriptions here. And this is the Elliott Wave Compass report. It's $39 a month. We publish 2 reports per week. And so that's about 8 reports per month. And we cover quite a bit in there, and you can see the subscription periods there. And there's no automatic renewal for this. So if you want to test this out and you don't want to have to worry about having to renew or cancellations, you don't have to worry at all. It's going to cancel automatically after 1 month. You just pay your $39, and yeah, hopefully that will guide people through some of the major markets in there.
Thank you, my trading warrior brother.
Thank you too.
Appreciate your hard work and you sharing it with our community today, Peter, very much.
My pleasure. Thanks again for inviting me, Dale, and good luck to everybody at ForexAnalytix. I know Blake and Stephen particularly, and cheers, guys, and thanks again for putting this all together.
Peter Goodburn, everybody, at Elliott Wave _WTI. Thank you, bro. Talk soon.
Bye,
all right, buddy. And everyone have a great weekend. Get ready for next week so you're not trading on the fly. And more than that, check out our community. And also, don't just count your pips, count your blessings. And I know everyone could find one. So How about the fact that you have money to speculate with? Is that a blessing? I'm not sure. Anyway, take care, guys.